Hello everyone, welcome back to another True Potential Do More With Your Money podcast. And on this week's episode, we're going to be talking about one of the age-old debates when it comes down to what to do with your money to best serve your retirement needs, property or a pension. And to talk about that on this podcast, I'm joined by Jamie Sexton, who's Director of Client Servicing. We've got Hayley Mack in the middle, who's our Operations Supervisor. And at the end of the table, Paul Durrans, who's an Investment Director here at True Potential. So welcome everyone to the podcast.
Hello, Peter.
Pensions v property. Is this something that you have personally considered over the years? It's certainly something which has crossed my mind, because when you do speak to people about what they're doing for their retirement, quite a lot of people just in your network will say, oh, well, I've got property I rent out, or I'm going to sell my house and downsize. It's amazing how much it is part of people's plans. Have you come across that?
Yeah, it's interesting, Peter, because it's something that's been going through my head a little bit at this minute in time, is whether I sort of add that level of diversity across my own personal portfolio. In terms of pensions and investments, etc. And I have been potentially looking at a property to say, could I add this as an addition? I went against it, so very quickly telling you my view on it.
Yeah.
I went against it. There is advantages and disadvantages. I think the main thing for me was I was slightly worried about the liquidity of the property, in terms of if I ever did need the money. I was also concerned about who was going to live in the property as well, in terms of did I want to be able to, did I want to be dealing with a tenant, etc. Right. And I think they were the things. So I actually decided to add a pension contribution instead.
Right.
So quite prominent that, being on this podcast, but that's actually what I decided to do.
Maybe that's why we chose the topic, Jamie.
Maybe
you can tell us all about your story. Hayley, is property and pensions, is this something you've personally thought about over the years?
Not personally for me, so I'm just recently on the property ladder myself. So I was a renter before getting, and then I think it's far too soon in where I am in my personal circumstances.
Were you a good tenant?
I was a good tenant.
Great.
5 stars.
Excellent. On your tenant rating?
Yes, absolutely.
Paul, property, ever taken your fancy?
I've thought about it. I know a number of friends that have a couple of additional properties, and on the face of it, it seems quite attractive. You have a couple of properties rented out and get that income. But from my perspective, and having the advantage of knowing pensions and investments for me, it's a lot easier investing in pensions. I have my own house already, so I want some diversification in terms of my net wealth. Yeah. And so having a pension, ISA, GIAs, and being exposed to different asset classes, equities, bonds, alternatives, which includes some property as well, makes better sense for me personally. But there's advantages and disadvantages of both.
Yeah. Well, I think that's a lovely link then into the discussion, Paul, because we're going to talk about some of the advantages and disadvantages of both. Let's kick off with pensions, because, Jamie, we at True Potential, we look after around about £32 billion of people's savings, which the majority of which will be in pensions. That's a lot of pensions across the country that we are looking after here. So it makes sense to start there then, and as a pension company itself, it's something which we can talk a lot about. Tell us about some of the advantages of a pension. I mean, it sounds obvious because it's there to help me retire. That's the advantage, right? But there are lots of little extras that come with a pension, like your employer paying, and you'll go into some of those. What are the top advantages of a pension?
I think one you mentioned there, Peter, was typically if it's a workplace pension, a lot of employers, which you need to check because not all do, but would do what you call contribution matching. So you put an amount in, they'll put amount into a certain amount, which is obviously good because they're putting, the employer's helping you save towards your retirement. The other area for me is obviously tax relief. Yeah. Every contribution, getting tax relief on that contribution as well from the government. So it's a great way from saving that perspective. And I suppose the final thing for me in terms of pensions is depending on what risk profile that you've chosen as a client in terms of where you invested, is you're getting more diversification. So typically it's not, if you're a balanced investor, Paul will explain this a little bit better than I can, but your portfolio is spread across. Yeah. But I think for me as an individual, I think the key, if you ask me, why would I put in pension over property, potentially I would probably say tax relief would be the main thing for me.
It's interesting, isn't it, Hayley? Because, let's say you put £200 a month into your workplace pension.
Yep.
That's what you put in. You're not paying, you're getting tax relief on that.
Yep.
And then your employer potentially paying in as well. So there's almost like two little kickers on top of what you put in. Do you think people, because obviously people calling in here or writing in on email, perhaps come through to your kind of team as well. Do you think people see the benefits of the pension, or do you think there's a mystique around pensions in the country, and has been for decades, that people don't fully appreciate the benefits of a pension?
I would say definitely the younger generation don't appreciate a pension. So, like, if you think you're automatically enrolled from 22 now in the UK, and I would say anyone who doesn't have kind of any background or knowledge of doing these things probably do underappreciate it. I think the benefits that you can get from it in long term when you start investing from so young is massive, which is something I've learned kind of over the last few years as well.
Yeah, I suppose I've come on, and I think it's a real key point is that power of compounding, so earning interest on your principal and your interest already generated. And if you got if you can start early and you've got contributions coming from the government, from your employer and yourselves, the power of that compounding investing is really significant, and it can, if you do the maths, you can really see your pot grow and really hit the targets that you want to achieve in the future.
And the earlier you do it, the better.
Exactly.
Yeah, this is the thing that you find if you use any sort of compounding graph, even using our website, if the earlier you start saving, the more time it has to compound. It's just a fact, and it can make a huge difference. That's why I say, getting money in at a younger age can have a more dramatic effect. But what I would always say, and every pension podcast I've said, is it's never too late to start saving.
Are you cold, by the way, Jamie? Because you've got your zip right up to your chin. I'd have brought you a scarf if I'd known you were.
Well, we are in the northeast of England, so yes, I am.
Yeah. Okay.
I suppose just to a fact that I only appreciated a couple of years ago is that if you've got a pension, it's outside of your estate, so it's not subject to inheritance tax, which is a big thing.
It is.
So it can pass down through generations tax-free.
Exactly. Because that's not the case.
Big
you had an
advantage.
additional property.
Yeah.
And there's other benefits as well. A pension's wrapped in trust. As a trust effectively. So, it's up to the discretion of the trustee. So on death, it can be accessible a lot quicker, typically, than other assets. So there is those benefits as well that could wrap up on inheritance.
Isn't one of the challenges with pensions? I'm not talking specifically about TP. In fact, we're the opposite. We'll come on to how in a second. But if you are a younger person, or any person for that matter, you're renting a property out, you can go and see your flat, your house that you rent out, you see the monthly rents coming in. To understand or to be able to visualise your point, Paul, about the compounding and the market growth that you can get over any period of time, whether it's a day, a week, a month, a year, whatever, to be able to see that, you've got to have access to your pension where you can log in and see the movements, you can see your employer paying in, you can see the compounding effect. In the same way you can walk down the road, see the flat you rent out, and you see the money coming in each month in your bank account. Not every pension provider will give you that kind of visibility of your pension, but we do here. And just explain to any new clients, Hayley, how people can, because they might think they've got to wait for that annual paper statement through the letterbox to see, and then you've got to dig out last year's and compare, and that's who does that. But we can do it right here, can't we?
Yeah, absolutely. So all of the clients have got access to an app and a client site. We also have a watch app as well, which is quite a new feature that we've released. It is day-to-day valuations. You can log in and you can see up-to-date valuations. You can track and you can monitor everything within all of the apps and client sites. You can really kind of edit it and monitor it the way in which you want it as a client as well. So some people like to look at quite small segments and see out like over a 3-month period. Then there's also people who are invested and kind of know it's a long-term gain for them, that they can look at it over all time and kind of look at it that way. Within the app as well, they've got access to all of the financial advisors, all of the relationship management team, which can help with all non-advised queries. And it's just really accessible. It's one of the things that we get questioned quite often, I suppose, when clients have kind of are new to us, and just having that accessibility kind of really opens a lot of doors for them.
And that's how you can see the magic that you're talking about, because I know personally, if I log into my pension, perhaps, I don't know, Jamie, is there an ideal time that people, not time, but is there a frequency should we be looking at our pension every single day? Perhaps if you understand that things go up, things go down, but the longer term trend is what's important.
When I talk to clients, I tell them not to log in every day.
What would be a good sort of
I think
frequency to do it?
You know, I always say logging in probably quarterly probably is enough for yourself, but it depends on the individual, Peter, because I log in every day. So I'm telling you not to, but I do log in every day. Why do I do that? Well, I like to live and breathe the technology. I want to see what our clients are seeing. Yeah. I want to envisage that, and I think that's quite important.
And you're in a different position because you're director of client servicing, and that means you want to check the service is working every day, and that its clients are getting what they need. So I get why you might do that.
But also, I would class myself as I'm a qualified financial advisor. I've got experience in this, so I understand there's going to be ups and downs, and I can roughly guess when the ups and downs are going to be when I look at the markets the day before. But I think if you've got that sort of anxiety over, seeing those ups and downs, if I logged in quarterly, you're seeing less of them. And I think this is the key. It totally depends as you as an individual. I've got clients that log in once a year and they're happy with that. Yeah. Go in and do their suitability review, check any circumstance from that perspective. And I've got clients that log in every day. But
something like, let's say logged in at the end of every month, a bit like renting a property. You get the rent coming in once a month. If you logged into your pension once a month as well, at the end of the month, for example, you would see that month's contribution that you've put in. You would see your employer's contribution going in if you've got one. You would see the compounding effect and any market growth on top of that. So that maybe is a comparison, because I do think that, as I said before, people perhaps just aren't accustomed. And if you've got a provider who doesn't give you that kind of access, you really should consider you changing a provider possibly.
Yeah, because we're all enrolled, aren't we? So within TP, we've all got we're all in True Potential Pensions, and we get an email once a month once the contribution's uploaded, and that normally ticks me to log in, by the way. I don't know about yourselves. That's when I would go and see my contribution. See how that's affected it. And I think that's typically, pushing clients through that route. So
and also it's not just that, but it gives you tells you whether you're on track, because obviously when you open the pension, you say, well, I want an income, or this is my goal in retirement of this, and without having to do any calculations, it just says, well, you're either on track or you're not. And if you're not on track, it might be that you're a couple of £100 short of being back on track. You can do the impulse save feature, which click a couple of £100 gets you back on track again, and off we go.
But I think, Peter, is the transparency that is really key. So if I think my girlfriend works at university, and she's no idea where her pension is, where it's invested, how much is in, how much is contributing. That transparency of information, I think everybody's entitled to just ensure that they're going to hit those goals in 20, 30 years' time.
And just coming back to the investment point, which is obviously your specialist area, Paul, I think Jamie, or you perhaps mentioned it before, that within a portfolio of many, many different types of asset classes and huge number of different holdings, property may well be in there, commercial property possibly. What kind of property would be in a portfolio? If I was in the aggressive fund or portfolio, which I am, what could be in there from a property point of view?
So if I look at the portfolios, we have actually quite a low allocation to property now. This is not direct property. If you think about the rules and regulations that govern the True Potential portfolios and the underlying funds, we have to offer daily liquidity. And so if anybody rings us up and wants to withdraw their money, we can provide that immediately. The challenge, if you invest in direct property, we know property is an illiquid asset. So the property, the exposure that we have is comes through what's called REITs, or real estate investment trusts, which is a listed company that invests themselves in different types of property. So it could be commercial, residential, industrial. It could be student letting accommodations. So very diversified, but generate a lot of income, and those income gets paid out to investors. So you typically see more real estate exposure in our income portfolio. So if you look at the balanced income True Potential portfolio, we have about 4 to 5% in real estate investment trusts because of that income.
So we talked about some of the advantages of a pension. Are there any disadvantages to a pension?
I think it depends on what you're saving, but obviously it's locked in, Peter, to a certain age.
Until age?
55 upwards at the minute. But obviously that is changing. So that's one of your disadvantages. If you're saving that now, that money will be locked up. I think that's a key thing. And I don't think you could call this a disadvantage. I've been very cautious of using that word, but something you have to consider is that it's obviously a legislation tool. We have seen changes to pensions over the years, and when I give advice, I've got to base it on these rules. But we don't know what governments may make changes to them. So that's, I suppose, not necessarily a disadvantage, but something you have to be aware of.
And even you can't access your pension until 55, or that'll creep up as people get older. Is it a disadvantage? I mean, it's certainly a feature, but I suppose it does prevent you raiding that pension for what might seem important in your 30s and 40s, and getting to the point in retirement where you then don't have enough. So, is it a disadvantage, or is it just a protection?
It depends. Yeah, it's both. I think when I sit down with a client, so if I sit down with someone who's a bit younger, looking to save for retirement, if they needed immediate money, then you would be putting them in a pension. Yeah. If you'd look at other immediate vehicles like an ISA or something like this, or you probably for someone that, in terms of investing, we wouldn't realistically go anywhere near unless they want to invest for at least 2 years. So there is, you can always have those initial conversations right up front. If they don't need the money and it is placed for retirement, then it is a good vehicle to say, actually, you can't get out of it. But you've just got to consider that is something that you have to be aware of.
Yeah, absolutely.
I think perhaps worth highlighting now, pensions are a great thing, but perhaps the rules around it, are they sufficient? If you think about, if you actually work out how much you want when you're in retirement each year, will you contribute enough to make sure that you hit that goal? Yeah. And I think, can more be done to really facilitate that?
I think for me, I'm a big fan of saving. I'm a big fan of encouraging people to save for their retirement. There's a savings gap within this country, and a pension is another vehicle for people to save into that will provide for potentially for their retirement. So that's the key for me in terms of the main advantage of a pension. It's a great way of saving and getting, growth above inflation.
I suppose another advantage for pensions is that even when you reach retirement, you don't have to take it all.
No, you don't.
You just take a bit of it, perhaps a regular income, and just allow it to continue to grow.
Because the rest, it can keep on growing, the remainder, can't it?
Yeah. Whereas a property, you probably have to sell.
You can't sell the back bedroom. You've got to.
You can't say room.
But when I've spoke to clients like later on who are retiring, probably straying into the property advantages here, having a mix of assets is quite useful, especially with inheritance tax for your pensions. So if you're getting an income coming from a property, you're getting your 2-state pensions typically, that can cover retirement income, and actually you can use your pension as that tax efficient vehicle that we're talking about for inheritance tax reasons before. So I've seen some great advantages where people have bought properties over the years, took advantage of low interest rates on mortgages and paid them off over a period of time, and now in a really strong position where they've got 2 or 3 properties, basically supplement their income, and they've got a nice pension there that's available for their families in the future. So there is some advantage having that mix of assets.
Absolutely.
But that's not just property pensions, that's just general.
Could be a lot of things. Yeah. If you've got lots of pensions, let's say you've had a few employers over the years or whatever, does it make, you can't obviously consolidate lots of houses or flats into one. You might think, well, I've got like 4 or 5 properties, I don't really want to be managing all that, I'd rather consolidate. You can't do that, but with a pension you can. You could consolidate into one. Does it make sense to do that?
Yeah, it's always easier to have everything in the same place. You can imagine people who, over their kind of work life, have had multiple different employers. If you're then looking at, say, 5 different providers, you've got 5 different logins, you're looking at 5 different kind of ways in which each pension provider works as well. It kind of saves time.
And if you feel you're not getting a great service from the pension provider you've got, or you're not happy with the performance, you can switch reasonably quickly.
Absolutely.
Versus, I don't like the flat that I bought. It's not, I don't like the area it's now in. You can't just, you can't just flick that away, can you? And within a few days, you're into a new. You've sold that and you've got something else.
Yeah. I think with a pension, is with that example, Peter, you've obviously got your advisor to speak to as well. Yeah. So if you're looking to say, actually, should I consolidate? Is it right for me? Speak to your advisor, and they'll go through that with you.
Yeah. Well, let's move on to property specifically then, because we talked about at large around the pensions and how they work and the advantages and some of the sort of bells and whistles that go with them. But in terms of property, what would be the main advantages, do you think, of owning property? And we'll get onto some of the pitfalls or some of the things that go with it in a moment, but what are some of the big advantages, do you think?
Take a silent point. I think you mentioned it before. So you can physically see it, and you can physically see it from a perspective. And property over the years has made good returns, made really good returns. So I think from that perspective, if you're looking to have something you can see, you can definitely make something from in the future and get a bit of income from. There's some advantages of it.
Yeah.
I'd also add just that it's typically a reasonable inflation hedge. So over time, properties and rent prices typically go up with inflation. So that would be an advantage.
And just psychology, I guess. I'm paying into my pension every month, but I'm getting rent in from a property.
Yeah.
So it's just in your head. You're probably thinking, well, one's me paying out, the other one's me getting money in. So naturally, I'm going to be more interested in getting money coming in.
If you think about it, in the lower interest rate environments where people have had mortgages against these sort of rental properties paying very little, you've seen people accumulate properties significantly over a period of time, and it's been advantageous for them. I've got friends and family that have got properties, and as I said before, it's that if you get a good tenant and it's for long term, then actually you can provide a cracking income for you, which can be really helpful when you're bolstering your retirement.
I wonder if a lot of people have ended up as accidental landlords, if they've maybe had a flat, maybe they've got their first property, they've got a mortgage, they've got on the property ladder, they've lived there for a few years, maybe their circumstances have changed now, or they've got a bigger income and want to move on, but they're unable to sell the property for the price that they wanted, and so therefore they haven't got the equity in that maybe they needed. So have they ended up slipping into, well, I'll just rent it out for a while I get my... Now I know there are rules now on owning a second property, and if you go in a primary residence and all that, I mean, what are the rules around second property ownership?
I looked at this because obviously the key is, if you're going to buy a second property now, it's this higher stamp duty tax. So it's worth you looking at in terms of the initial outlay of that. Any income that you get from that property is taxable income. So in terms of PAYE, so if you're a higher rate earner, then potentially that's not the right way of doing it. So I think from the people that I speak to, sometimes it's actually, unless you've got 4 or 5 properties, they don't see it as worth it, rather than just have 1 or 2. But it completely depends on the circumstances. There's advantages and disadvantages.
Yeah. And obviously you've got to have the initial outlay, you've got to have the capital to be able to go and buy that property in the first place. I mean, I'm talking before about money, pension paying out, rent coming in, but that only happens if you've got the money up front to be able to go and buy that second property, which could be what? I mean, you might need tens of thousands of pounds to put a deposit down, right? Yeah.
And then you've got all the maintenance, the upkeep, the changing boilers, whatever it is, over the years, and it all adds up, and it's all effort and time.
Yeah.
And then, of course, there's the repayments. Because you're still, unless you're buying a property outright and renting it out, which is, you can need even a bigger sum of money, you've probably got a mortgage on those properties. And we've just seen in the last couple of years mortgage rates shoot up, which I'm assuming has meant a lot of landlords aren't making the margin, the profit that they probably were before that.
Exactly. And if I think about how property or real estate investing has performed over the last 12 months, it's often 2 or 3 years, it's massively underperformed because higher interest rates means the cost of financing for these companies has gone dramatically higher, and it's meant that a lot of projects have been unviable. But also from a commercial perspective, post-COVID, the changing working habits, so working from home dynamic, means that office rentals, the demand has just fallen away, and too much supply, prices come down. And I've had to readjust.
And if you are going back to the landlord point of view, if you've now got a bigger monthly mortgage payment that you've got to pay out, you can't necessarily just hike your rent to cover it. So you could be left with paying the difference, couldn't you?
Yeah, you could be.
And we see a lot of, especially with the new government coming in, talking about renters, and it seems to me, as being a landlord, there's a lot more. I mean, I could be wrong, but it just feels to me that there's a lot more. If it's not regulation, but certainly the power balance seems to sit with the tenant, rightly or wrongly. And I mean, that's for other people to discuss. But do you pick that up as well? That if the landlord's not an easy. I mean, I was watching a news article or report on the TV a couple of weeks ago, and there was a landlord on saying it's just actually there's just too many strings attached to being a landlord now. Yeah,
it is. If you want to sell the property, then it's not just a case of you've got a month's notice and you're gone. I don't believe anymore. So I think it's. There's obviously, quite rightly, rules around what you're able to do with the people in your property. So
on balance, do you think then is the answer to all of this then, is it about a bit of diversification? It's not, we've obviously picked the title of pensions versus property, but in reality, it's not one. It might not be one versus the other. it could be having that mix. But fundamentally, it comes down to your own personal goals, and as you said, Jamie, taking advice from an advisor.
Yeah, definitely taking advice from an advisor on the best thing for your retirement plan. As I said, there's going to be advantages and disadvantages to both, but worth sitting down for an advisor. Let's
just throw a little curveball in then, introduce some of the other types of ways you could help to fund a retirement, because the context with today, of course, is all about what could help me fund a retirement, property or pensions. But I mean, there are other, where do ISAs sit in it, Paul? Give us a view on, if let's say you were going to, you've got your pension, you might think later on about renting out, getting a property to let out, but there's other investment types, aren't there, as well?
Yeah, so you have an ISA, which any contribution that you make is tax-free, so when you come to withdraw it, you get all the benefits of that. I suppose
sorry, just could the underlying fund or the portfolio you're in an ISA be identical to your pension, or would there be differences?
No, there'd be, assuming that it would be the same. It would be the same.
If you're in the same, choose the same risk
same risk
category and
profile,
things like that.
You can have some flexibility around that. You might want to go with a slightly different fund or a slightly different portfolio, but in general, you can access the same investments under each. An ISA, GIA, or a pension here at True Potential. There's advantages of an ISA, clearly, given it's tax-free. I probably think about that more shorter-term time horizon for myself compared to my pension, which is more longer-term.
Yeah. And do you get a lot of people, again, ringing up or getting in touch around with questions like that? Like, what should I be doing? Are there other things I should be thinking about? Or is that kind of thing that we get coming in?
Yeah, absolutely. I think the kind of one thing for us to say from our team and our team's perspective is, if you're not sure, you need to be speaking to your advisor. It really, really depends on everyone's personal circumstances, but it's not uncommon that people have both.
Yeah, interesting. No plans to become a landlord anytime soon, then? No?
Yeah, I'm still debating on it.
I can tell you're not done with the idea, are you?
I'm not done with the idea. I'm still debating on it. I think there is some advantages for me personally. I like it's interesting when I speak to so many clients, I like the idea of it topping some of my retirement, but it's the same with everything. You weigh up in your mind whether you said you fancy the hassle of having.
I think when you've got, because we've got children as well, so when with your kids, I suppose you're thinking as well, it might be somewhere in years to come that they could have, or when if they go off to study or whatever, they've got to potentially have a flat. I suppose in the back of your mind, you might have that in there as well.
Yeah, I think if you're buying a flat for them and they're going to rent it off you, but then you probably don't get the rent. Who knows? I guess this is the thing. There's this. It's a really interesting subject to think about. Is it if you generally are thinking about it, because yes, the tax implications, yes, how you set it up, and do you get a mortgage, etc., and how that works. So there's some very, very successful people that have lots of property.
Yeah. I've often wondered whether, if you're going to go down the road of property, you really need. I mean, I'm sure you don't have to, but would if you were going to do it, would it make sense to have 3, 4, 5, 6 properties and do it properly and have multiple streams of income coming in, and than just say having one? And I go back to my point earlier. I think post say 2009, when house prices did dip, and we know about the 100% mortgages and people left in negative equity. If you more or less couldn't sell your property, or you were going to sell it at a negative, so maybe you kept it and you've now got one. I can almost envisage that being more trouble than it's worth. I could be totally wrong, by the way, but I can see how that might be, because you haven't really done it because you see that as being a strategy. You've done it because I just had it, because I just couldn't sell it, or I didn't want to sell it for the price. So therefore, I've got one, but it's not going to bring in. It's not going to be game-changing rent that's going to bring in, I would assume. However, if you've got 4, 5, or 6 properties, that feels more strategic.
Yeah.
So if you were going to do property, is that the way to do it?
It's interesting. I've got family in Edinburgh, and they would class it as a holiday, a holiday flat right in the centre of Edinburgh. And they had been using Airbnb as a way of obviously bringing people in, which is quite a common thing. And in Edinburgh now, you have to get a license to effectively use Airbnb because they're so short on property.
Yeah.
So basically, they're being now forced into, the only option is for them to rent it, because they're after renters. So there's opportunities in that as well.
Yeah.
It's interesting.
I suppose if you've got 5 or 6 properties, though, it depends how you're financing them.
Yes.
If you've got multiple mortgages out on them, and mortgage rates go up, you're exposed to a lot there.
Absolutely.
And then just the amount of time and effort that it would take to manage those 6 properties. It'd be a lot.
Well, that's what I mean. It becomes almost like a full-time
exactly
job and everything else, doesn't it? Then complicated. Well, look, I think we've shed some light on it. Jamie thinks he might one day be like, would he make a good landlord? Would you want to be his tenant, Paul?
I don't know about that. So you're going to keep it up to scratch and everything.
Would you be worried if Paul was your tenant? Would you have sleepless nights?
No.
He's having parties again till 3 o'clock in the morning.
Well,
the lampshades had it again.
Knowing Paul, how long I've known him, that's definitely not going to happen. So I'll be quite comfortable.
What about him?
Definitely not, no.
You'd be rejected.
Yeah, probably, yeah. Nah, only kidding. Terry definitely as well.
Good. All right. Thank you very much, Paul, Hayley, and Jamie as well. I think what the point I suppose we're making is that it's slightly horses for courses, but also a rounded retirement plan needs advice. And it will be very personal to you. So what is the right thing for you to do and the right mix of it? That's always something that's worth sitting down with an advisor and having a conversation about. And that might mean ringing us up, come to see us, we're right here, or get in touch with Hayley's team and the rest of us here, and we can put you in touch with an advisor and give you that proper conversation, which I think is the best thing to do. So thank you very much for watching. Another bit of advice would be to click and subscribe to this podcast, because you just never know what topics we're going to be talking about that you've been thinking about. It might be that happens next week. So give us a like, hit subscribe, and we'll see you next time. Bye for now.